Good evening, traders. Raghi here, and we're going to take a deep dive into the Euro-US dollar because this is a very interesting pair based upon what happened before 2 p.m. Eastern and after 2 p.m. Eastern. So we had the Fed minutes today, and while there really wasn't any argument about how much, the 85 billion was still something everyone agreed upon. The vote passed 11-1 with the typical dissenter being the Richmond president, Lacker. None of that really shocked the market. I think what really shocked the market and what caused the U.S. dollar to continue rallying higher, it started off the day that way. So this isn't anything that's an about face. The Dow was kind of lethargic. So again, nothing really surprising there. But the acceleration in the dollar that initially started with euro weakness, and see the acceleration we saw after 2 p.m., but the strength we saw in the dollar based upon the euro weakness was accelerated because, I think, basically how the market interpreted how the Fed members felt about when this program, this bond buying program, should end. When? Should it be through 2013 or just towards the end of 2013? Now, we're probably talking ultimately about just a handful of months. So why the dramatic reaction in the dollar? Ultimately, the market hates any kind of indecision, and certainly when it comes to FOMC members, this kind of dissension or this division certainly doesn't please the market. And boom, we see the movement higher. Because I do believe, and this does reflect it, the way the reaction was so dramatic, I do believe that traders did expect the bond buying program to continue further past 2013, for sure, because the open-ended agreement that the Fed sort of made with the market was that we would see this bond buying continue until we saw the jobs numbers improve, and until we saw the kind of improvement that he laid out in a very subjective way. But until we saw the kind of improvement he laid out, we were going to see this. So now what the market took in was, hey, wait a minute, they're talking about ending this thing. Yes, maybe not for 12 or 16 months, who knows, but they are talking about ending it. And that's the way the market always behaves, as a forward-looking discounting mechanism. And now we're talking about looking ahead better than 12 months, and that's why the dollar went up. That isn't the only reason, okay? Like I mentioned, the dollar started the day pretty strong, up about 25 to 35 ticks. And the reason for that, look no further than the way the euro was behaving. We saw the German manufacturing number start to become the focus after the relief rally, after yesterday's optimism and just flat-out euphoria caused that rally in the Dow. It was widely expected that that rally would be sold into as all the money on the sidelines and equities rushed the field. And at some point, they broke the party up. Now, I'm not saying the Dow is going to sell off. That's not it at all. But we're seeing that exhaustion possibly coming into the market now. And if the COMDOLs and here the euro rallied because of dollar weakness and because of this optimism, because of this risk on yesterday, we lost a lot of that fuel in the tank for the euro. So what else was going to keep it moving higher? And then you see this sudden U.S. dollar strength, especially again, punctuated by the 2 p.m. Fed minutes, and the euro really couldn't do anything about it. So the interesting push-pull for you non-Forex traders here is when we see the U.S. dollar strengthen, you're going to see the euro weaken, and then that's going to cause the kind of move we see here. Sadly, however, when you take a look at the way in which this market was moving up, this could have been a nice swing trade, and I had a very brief trade going on in here until I had to just go ahead and accept the fact that the dollar is beginning to really drive what's happening in terms of the movement, not the euro, the dollar, and that's when I had to start thinking short term, and that's when I direct my attention down to, say, a 30, 15, or 5. Why those time frames? Well, again, I took my chances on a very brief entry based upon support and some minor psychological level support. Either we had support at 3,100 and I gave the market to 30.77 to wiggle around, or I'm out of here. So once we started to see that weakness, what I had to then do is ask myself, okay, if this market looks like it's chipping away at 3,100, which we could kind of see throughout the day. The building blocks made it appear as if the bulls were willing to step in and keep 3,100 afloat. But ultimately, the way we were chipping away at this, the way I put my orders in the market and the way I was viewing my early morning euro was basically a pre-2 p.m. and a post-2 p.m. type of environment, because I knew the possibility for either accelerated dollar weakness or accelerated dollar strength could put me in two very different positions in this market. The one we want to be most keenly aware of is what happens if we get that dramatic dollar strength, because that would just turn the euro-US dollar swing buy that I was looking at on its head. So after getting stopped out, my next best bet is to start to look for opportunities to short the market. And that's where I'm going to be now. I took a quick momentum play, nothing more, nothing less. I got in, got out. But now moving forward, because this isn't necessarily a counter trend trade, because we have broken the wave on the daily, I still want to stay nimble. Because was today an overreaction in terms of dollar strength? Possibly. So what I like about the 5, 15, 30, especially the 15 and 30, is that I can play the continued trend, this continued downtrend on this time frame, but it's nimble enough that if I get some dollar weakness and a resumption of euro strength for whatever series of reasons, I can go ahead and trigger what's known as a wave reversal, which would allow me to basically, one, stop swing trading, stop taking these shorts on bounces. Okay, I'll stop swing trading. Likely the way this ends is I get stopped out of the most recent swing trade, but if the reading of the CCI is above 100, I'll look for a long entry. So that's the way that would play out. And really anything above 3,100 with momentum through the minor 3,120 level would be a nice way to play a nice, nimble, short-term, intraday trend reversal. Again, we're talking about an intraday trend reversal here. So I'm basically retreating to short-term time frames, knowing that the psychology could twist and turn in terms of what's happening to the dollar, and therefore what's also happening to the euro. We don't know which is going to be the driver day to day with the way the news is coming out, so keep an eye on the headlines, but that's the way I'm going to continue to manage this euro-US dollar.